Ladies and gentlemen, good day and welcome to 5-Star Business Finance Limited Q2 FY24-25 earnings conference call hosted by Ambit Capital. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Raghav Garg from Ambit Capital. Thank you and over to you, sir.
5-Star Business Finance Limited represented by...
I'm sorry, sir, your voice got cut out. Can you repeat that?
Sure. Good afternoon, everyone. We have with us today the management of 5-Star Business Finance Limited, represented by Mr. Lakshmipathy Deendayalan, Chairman and Managing Director, Mr. Rangarajan Krishnan, Joint Managing Director and Chief Executive Officer, and Mr. Shrikant Gopal Krishnan, Joint Managing Director and Chief Financial Officer. Without much ado, I would like to hand over the call to Mr. Lakshmipathy Deendayalan for his opening remarks, post which we can open the floor for questions. Thank you and over to you, sir.
Thank you, Raghav. Good evening, everyone. A warm welcome to all the people who are in the line. Happy to take you through on the second earnings call for this financial year. So let me straight away jump into the operational numbers and few updates which I wanted to share with you all. First, let me take you through on the branches. We have opened 113 branches in September quarter. Out of that, 32 are new branches and 77 are split branches. Hope so that you people know what the split branch concept, what 5-Star has put in. Let me repeat, the split branches will address the concentration risk in a location. So we'll keep continuing the split branches as we go forward. Now let me take you to the disbursement. We had a good disbursement of 1,251 crores versus 1,204 crores last September, with registering a growth of 4% year-on-year, and 1,318 crores in last quarter, June quarter, which shows a negative growth of 5% Q-on-Q. Yes, we have slowed down our disbursement. This is a conscious strategy to moderate our portfolio growth for the full year. Let me take you to the portfolio. Our portfolio stands at 10,927 crores versus 10,343 crores in June and 8,264 crores in last September, registering a 6% quarter-on-quarter growth and 32% year-on-year growth. Considering the current environment and regulators' views, what we hear, the board has taken a call to slow down the growth. So our guidance for the financial year 25 will stand at 25%. We will take a call in next financial year. Let me now move towards the collections. We have done well in our collections. Our September quarter collection efficiency was at 98.4%, comparing with 98.5% in June. And unique customers collection, which we call Due 1 Collect 1, was at 97% in September versus 97.2% in June. Now taking you through NPA, our gross stage 3 assets was at 1.47% versus 1.41%, which had an increase of 6 bps. At the current scenario, we have performed well both in collections and maintaining a good asset quality. Now let me take you through on the liability side. We were able to diversify our liability from banks to other forms of borrowing. Shrikant, CFO, will speak more about that. On the borrowing cost for the quarter was at stable at 9.65% versus 9.65 last June. Incremental borrowing cost was at 9.52% versus 9.47%, with an increase of just 5 bits. Now let me take you through other updates which I wanted to share with you all. First, the rate of interest. In line with our commentary over the last many quarters, we have now decided to drop our lending rates on incremental disbursal starting from 1st November 2024 by 200 bits. That is from 24.5% to 22.5%. I'm happy to say this. Since our portfolio is a fixed rate portfolio, the spread compression impact will be on the incremental disbursement. On the second update, which will be more interesting, we have done a viewer scrub of all the primary applicants on active loans as on September 2024. Out of our total active loans of 4.3 lakhs, we find that about 14% of our loans, which is 59,000 loans, are over-leveraged. That is, the applicant having 3 or more loans with other financial institutions. Of the loans which are over-leveraged, only about 1,600 loans translating to just 0.4% of the total active loans have exhibited lower collection efficiency in last 6 months. Let me repeat. Only 1,600 loans translating to just 0.5% of our total active loans have exhibited lower collection efficiency in last 6 months. We are monitoring this portfolio very closely and also decided to implement stricter underwriting norms for over-leveraged loans going forward. So with this updates and numbers, now I'll hand it over to Srikanth to go more deeper into it. Thank you.
Very good evening to all of you. As Mr. Pati has highlighted, we have had a good quarter in the second quarter as well, despite some sectoral headwinds, especially those that are being faced by the unsecured lenders. But we being a fully secured product with strong underwriting and collections mechanism, I think we have managed to come out with a good set of results even during this quarter. We have an active loan base of 4.3 lakhs, so we are still not really putting too much of money into the hands of the same borrower, but diversifying our portfolio into a much larger base of borrowers. Our yields continue to remain consistent at around 24% or so. With the drop in yields that we will be doing from 1st November, you will see the incremental yields going down, but for it to get reflected in the portfolio will take some time. The cost of funds again remaining flat at 9.65. This has ensured that our spreads have remained flat compared to the last quarter. There has been a slight drop in the net interest margin, primarily on account of leverage with the quantum of debt going up. Our cost to income, again, pretty much stable compared on a sequential quarter. And as we have been guiding in the past, we expect our cost to incomes. And when we mean cost to incomes, we are also including the credit cost into this. So inclusive of credit cost, we will be at about 35% of cost to income even in a steady state scenario. Healthy ROA is at around 8.3%. Our ROE has just crossed 19% for the first time. So this is again on anticipated lines, compression in ROA, and you will see ROEs sort of going up. From a borrowing perspective, we have 43 lenders who have lent monies to us. As we have guided in the past, we are clearly looking at moving towards other than banks to get our debt, and to that extent, we have onboarded Nippon Mutual Fund and Kotak Mutual Fund as lenders to us. They have subscribed to our PTC transactions. Incidentally, given that this is a public call and today it could be a public news, we also had HDFC Mutual Fund subscribing to our to our PPCs today, HDFC and HSBC Mutual Fund. So clearly, the intent to diversify the borrowings out of the bank is showing a good traction. We have dropped our other than bank borrowings from 74% to 70% during this quarter. These come in at slightly higher rates, which is why we are seeing the incremental debt coming in at 9.52% as against 9.47% last quarter. We continue to be good on the liquidity buffer and unavailed sanction lines. So we had a liquidity buffer of close to 1,700 crores and close to 250 crores of undrawn sanction lines from banks and other institutions. On the collection efficiency, there was a very marginal dip, which has also contributed to a slight increase in our DPDs. But if looked at from the context of what is happening around in the industry, I think the numbers that we have delivered are very impressive. On the provision coverage, we continue to be attractive. We are maintaining about 1.65% of ECL on the overall AUM and about 52% of provision coverage on stage 3 assets. So we will continue to, like we said, we will continue to remain cautious on this and build adequate buffers in good times for any contingencies that might arise. We clocked a PAT of 68 crores for the quarter, which is growth of about 34% on a year-on-year. And on a sequential basis, our PAT went up by 6% from 252 crores to 268 crores. Net worth is strong at about a little over 5,700 crores. So Mr. Pati has already given the updates. The over-leverage issue has not really caused much of an issue for Five Star. The borrowers of Five Star are continuing to pay to us. So given all of these things, I think we will continue to remain very focused, remain cautious, and look at the environment closely before taking any of the decisions, because we all know what is happening around. But the silver lining for us is the portfolio of Five Star is continuing to perform extremely well, and we will continue to keep monitoring this as we go forward. So on that note, we'll take a pause and we'll open out for any questions that any of you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Renish from ICICI. Please go ahead.
Hi, and congrats on a good set of numbers. So just two things from my side. One, on this, a few business model changes, what we have done, like lower growth and a rate cut. So what kind of a profitability impact do you see in FY25, FY26? And also, does it also mean that the steady state ROE, which you guys might have thought about, maybe, when we started this business, and now given the changes, which are, sounding more of a structural in nature, what kind of ROEs this business can now generate going ahead, and the short-term impact because of the changes?
So, Renish, on the first point, definitely there will be an impact in the profitability on account, more so in FY25 on account of the lower growth. Because like we said, the yields dropping will not have much of an impact because it's going to be on a very smaller portfolio rather than we have about 11,000 crores of portfolio which are fixed rate and running at a higher rate. But because we would grow about 4-5% lower than what our original guidance was, there will be an impact on the profitability. We have not really worked out our numbers, but I don't think there is going to be a significant compression in our ROA. So given where our assets will end at, I think we should be closer to about 8% of ROA for this year. But over a period, I think that definitely will drop to about 6% or so. But Renish, this is not a new information that we are giving to you today. In fact, all the while we have been saying that our steady state spreads will be about 12%, which will translate to a steady state ROA of about 6% or so. So on a steady state, there is actually no change in our guidance. The only change will probably be on the growth. But at this point of time, we are not giving you a growth guidance for a longer term. Like Mr. Pati said, the 25% growth is for this year, but we'll continue to keep monitoring how things change. And, growth is something that we can always fine-tune as we go forward. So I don't think there is an issue from a steady state ROA and ROE as against what we have been talking. It is just that maybe it will happen in a little more faster manner than the sort of gradual manner that we highlighted to you, maybe when we had been meeting you in the past.
Got it. So, Marcel, I mean, we don't foresee any risk to our 12% steady state spread reduction.
At this point of time, no, Renish. Today, I think the way that the environment is changing, we are also, while we can be as proactive as possible, there are times when we have to be reactive. But at this point of time, we don't really see a challenge to our 12% spreads.
Got it. And sir, my second question is on the borrower base, right? So, given, the kind of news flows, what we are getting on the MFI side, and given our ticket sizes, maybe if you can just clarify, what percentage of our borrower base are having MFI loans, and how is the credit behavior of that pool? And linked to that, do you foresee any, let's say, collection challenge in that pool, especially the ones who might have 2, 3, 4 other MFI loans?
So, Renish, just to give you a little bit of context, what we have been telling even in the past, our belief, and today with data it stands a lot vindicated, is the fact that the borrowers have not seen a compression in their incomes, but obviously there is some level of over leveraging that has happened. So what is happening is people are starting to prioritize, and in the order of their priority we stand almost on top. So which means that they are repaying us. So and out of this scrub which we have done, we see that about roughly 30% of our borrowers also have an active microfinance loan as we speak. And we are not seeing, while we have not looked at what kind of delinquencies those microfinance institutions are facing, because we would just have an overall number and not an institution-wide number. But even on the portfolio where there is a microfinance overlap, we have not seen any deterioration. So the lower collection efficiency that we are seeing is just on about 0.4% of our base, which is about 1,600 loans. So at this point of time, we don't believe that the issues that are being faced by the microfinance companies from their borrowers, the similar borrowers are prioritizing us and repaying us without any issue. And there is no, early warning signal or whatever it is that this could also percolate to our portfolio. But like we said, we will continue to keep monitoring the over-leveraged portfolio very closely and be ready for any actions if they are warranted.
So, Ramesh, let me repeat and give confidence to the listeners. Five-Star in last 22 years, we have seen 5 crises, starting from Andhra crisis, what happened to MFI, and then Demon, then COVID, and COVID-2, and now what we all call as over-leverage crisis. In all the above 4 crises, Five-Star came out very successfully, because I keep repeating, even though we lend to middle and lower middle class people, during the stress time, they prioritize whom to pay, whom not to pay. So that is why you see the other players who are suffering, whereas the mortgage players like Housing and us are comfortably placed because of strong security what we have and our collection infrastructure what we have put at the ground level. Both are giving a good result in this quarter, and I hope and I'm confident that this will continue till this gets settled.
Got it. No, this is very helpful. Thank you and best of luck, sir.
Thank you.
Thank you very much. The next question is from the line of Viral Shah from IIFL Securities. Please go ahead.
Hi. Thank you for the opportunity to let me ask the question. So I had 2 questions. One is that with regards to the growth rate percentage specifically, which is 25%, is there any logic behind it, or is this just based on the discussion with the regulator or the feedback that you would have gotten?
See, as I said in opening remarks, board has considered the current environment and regulators' view, which you and me hear from all sources. So board has taken a very conservative call that to slow down the growth in this over-leveraged time. So we feel that our board has taken a right call and not grow at the time when everyone speak about over-leveraging. So we have taken a call to step down a growth a bit from 30% what we said to 25% for this financial year. As I said in opening remarks, we will revisit this in the next financial year. When we feel and when the board feels that this is the environment is good, we will go back to our stronger growth as we have been doing in the past.
Thank you, Mr. Pati. That's crystal clear. On the second question, is that you mentioned that the 14% of your portfolio is basically over-leveraged. Is this on value basis or on volume basis? Like, is it in number of customers or by value of the loans that these customers have with you?
So this is on the basis of number of accounts, Viral, not on value. In fact, on value it will be slightly lower than this also, because if they have taken so many loans, I think our loans also will not be at, let's say, 3.5-4 lakhs. So our amount would have been lesser. So this is on an account basis. We have not done the analysis for the value, but very clearly at the value basis, this number will be smaller.
Also because there would have also been a rundown on your exposure, so of course it would be lower than that. Got it. And as a corollary to that, if we get a color in terms of the definition that you use for these over-leveraged customers, is that they have 3 or more other loans. Do you have color on what are these other loans? Are they secured, unsecured? What is the value of the outstanding of those other loans? Any of those things?
So, again, primarily unsecured, Viral. So we have seen overlaps with MFI, overlaps with gold loans, overlaps with vehicle loans and, agri kind of loans. The overlap with LAP, housing or secured business loans are very, very small. Typically the number is, like we said, 30% overlap with microfinance and maybe a similar overlap with gold. Rest of the overlaps are smaller than 30%.
Right. And when you mention that this overlap with vehicle loans, which vehicle? You mean to the two-wheelers?
Two-wheelers, yeah.
Okay. And
it could also have some
Sorry?
Some CVs could be there, but predominantly two-wheelers.
Got it. And when you mentioned the LAP or the housing piece, do these borrowers have another house or the property against which they would have taken this?
They should be having, Viral, because we don't do any pari passu charge. It's an exclusive charge. So if they have taken money from us on one property and if they have taken another housing loan, it should be on a different property.
Got it.
Like I said, the numbers are extremely small.
Got it. That's very clear. Thank you so much. And all the best.
Thank you.
Thank you very much. The next question is from the line of Manik Bansal from Master Capital Services Limited. Please go ahead.
Hello. Am I audible?
Yeah, please go ahead.
So first of all, congratulations on strong set of numbers and thank you for the opportunity. So I'm having a question on our average loan to value ratio has reduced from 40.5% in quarter 1 to 39% in quarter 2, which means that underlying collateral increased around 2200 crores on loan book increase of 583 crores. What can be the possible reason? Is the bank focusing on prudent lending?
So Manik, the growth has slowed, right? The disbursal is lower. And on an LTV basis, when the loans run down, we don't revalue the collateral, but even assuming the same collateral value, when the loan runs down, obviously there will be a drop in the LTV. And when you are not adding, higher LTVs at the pace that you have been adding in the past, this number will continue to keep dropping. So you will always see a portfolio LTV that will be much in a lower growth phase. The portfolio LTV will continue to keep dropping, dropping a bit quarter on quarter.
Okay. So another question is on, we added 113 new branches this quarter, right? but the company's loan portfolio grown about 583 crores only in quarter two. What can be the possible reason for this low growth?
So Manik, we have clarified that most of these branches are split branches. So a split branch is essentially one larger branch getting broken into two. So that does not automatically increase your business outcome or portfolio. So it's more a risk management measure, which we have been explaining in the past few quarters. So over the last quarter specifically, we had focused on most of the branches which have more than 1,500 loans, and that's the effort which has happened. So almost 77 branches out of the 113 that we have opened are split branch category. Also, the other point to note is when you open a new branch, it takes at least 3 to 6 months for the branch to stabilize. So these are investments that you are doing now, and over a period of time, these will yield results. So it's not an immediate and an automatic increase in business.
Okay. Thank you. And the last question is on like the company securitization portfolio. The company securitization portfolio has grown from 14 to 18%. Okay, so there is a 4% increase on securitized borrowing, and as the company's con call shows that we have onboarded Kotak Mutual Fund and Nippon Mutual Funds. So will this impact the cost of funds in coming quarters?
Sorry, we missed what is the question? We have onboarded Nippon and Kotak for PTC transactions. What is the question?
So will this impact the cost of funds or overall borrowing mix?
So this is slightly, like I said, Manik, this is slightly at a premium compared to our, let's say a bank borrowing. But we are very clear that we want to diversify our borrowing sources. So we end up paying about 20-25 basis points premium on this. But generally, the way these things work is it will typically be higher cost in the initial transactions. But once they get comfort subscribing to our portfolios and seeing the performance, they are hoping that at some point of time the cost will start going down. So we don't really see a long-term impact on these of these transactions on the cost of funds. But for getting the diversification impact, we have paid a little bit of premium.
Okay. Thank you so much. All the best for your future quarters.
Thank you.
Thank you very much. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, good evening, everyone. Thank you for taking my questions. Shrikant, the first thing I just wanted to understand, I'm seeing on our slide 6, NIMs have expanded by almost 20 basis points QQ. Is that a right observation?
Yes, Abhijit, NIMs have expanded a little bit.
So, how should we understand this? Because, all along what we are understanding is there are no yield increases that we are taking. On top of that, I would say cost of borrowings, what you have reported is, I would say largely stable. So, and leverage is indeed going up. So, what explains this NIM expansion?
So the last point is where the difference is. The leverage for this quarter has actually come down a little bit. While it's not material, but if you look at our debt equity, it's come down from 1.23 to 1.20. So the pace of net worth growth is higher than the pace of the borrowing growth.
Got it, sir. This is clear. The other thing is, sir, obviously, audit for the last year, I'm guessing would have happened by now. In addition to industry loan growth and pricing that you have spoken about, any other observations in the audit, RBI audit?
Abhijit, I have not said this is the outcome of the RBI audit. I said the board has taken a clear view and what commentary that we have been saying for last quarters. Based on that, the rate of interest has been reduced 200 bps. Which we have been saying to the market for some quarters, and we have done it now with the approval of the board, and this gets effective from 1st November.
Got it, sir. This is clear, and let's spell this out earlier as well. But what I was trying to understand, Pati sir, was the audit is over now, and there are no observations from RBI, right? Is what I'm saying.
So, which is FY23 inspection report has come. There are no material observations. There are qualitative observations, obviously, how we can strengthen our process around the complaints management, not compliance, but complaints management. So there are qualitative observations, and we have very clearly taken those suggestions from RBI and will be implementing that. In fact, we have implemented most of it and given compliance to RBI also. FY24 has also been completed, but we have still not got the final report from RBI. Our interaction with the inspection team during the inspection leads us to believe that there are no red flags, there are going to be no major observations or inspection findings. But again, we will just want to wait for the final report to come in before we give you a very clear answer.
This is useful, Srikanth, sir. I mean, and very, very heartening, to say the least. Just one last thing I wanted to understand. While you have already articulated that this 200 basis points cut in our incremental lending rates that we are taking will obviously not have too much of an impact on yields this year. But given that, I mean, in the past you have said roughly around 25 to 27% of our books, of our existing loan book runs down every year, how will this impact come into the portfolio yields over a course of time?
So over a course of time, Abhijit, for sure, what you are reading as 24% today, 24.1, will gradually start going down. In fact, it will go down much more, quicker than what we have been guiding in the past. So that's what I answered Renish also initially. The impact will be on the faster pace of yield coming down on the book than what we had guided. So originally we were thinking that, the book will start being at around the incremental yields in 3 years. But maybe today that could probably be in FY26-27, you'll start seeing some impact which is more sharper than what we would have guided. So 25, I think we will largely be around 24% or slightly lower than that. But 26-27, the drop will be a little more sharper than what we have been guiding in the past.
So Abhijit, let me reiterate what Srikanth said earlier. So our long-term guidance, 3 years, 5 years down the line, we will be in the spreads of around 12%, and our return on assets will be around 6%, and that's the steady state scenario that we are looking for.
Got it, sir. So this is clear now. Thank you so much, and wish you and your team the very best.
Thank you, Abhijit.
Thank you very much. The next question is from the line of Dinesh from Finsight. Please go ahead.
Hello, sir. Can you hear me? Am I audible?
Yes.
Okay, sir. Thank you for taking my question, and really, great set of numbers under current tough situations, which we understand. So my question is, I would like to know, we have split the branches and we, if I remember, you mentioned in the previous call that we would like to reduce the number of employees per branch from somewhere around, say, like 20 odd we have right now. From what kind of a number we are looking at? Like, I mean, will it be somewhere in the range of 10 to 12? Because definitely some of the employees will get split, right?
So, Dinesh, on a steady state, we expect once a branch reaches what we call as an ideal branch kind of a scenario, it will have an average of about 10 to 11.
Okay, 20 to 11, right. So second question, I mean, on the same lines, like say, we are increasing our branches. We are definitely adding more employees here, and we are reducing our interest rates maybe like, 200 basis points, and we know the situation is very tough. What kind of a situation actually is there out in the market, like say, and we are reducing our growth targets as well. Like, I mean, are we expecting the situation will become even worse in the next maybe 2-3 quarters? Or are you seeing maybe the last signs of, the revival are there? If you could just give, on the overall micro, what's your view?
Dinesh, I'll add a couple of things, probably invite Srikanth also to add his viewpoints. I think the first point on the interest rates, we have repeated multiple times, even as part of this call, that this is a well-articulated strategy that we have had, and we have been sort of talking about this for the last few quarters. The spreads that we had additionally enjoyed was because of the lower borrowing cost, and we were waiting for the most appropriate time to pass this on. And today the board has given us the final approval, and we are going ahead with the passing of about 200 basis points benefit to the customer. So this is exactly as we have anticipated, and this does not deviate from any of the guidance that we have given on the spreads part. So that's clear. The second part I wanted to also reiterate is that we are not seeing any stress scenario from our books at this point of time. And the bureau scrub that we have done is additionally giving us the confidence that if at all, we'll have to look at over-leveraged customers who are sort of not behaving well with us from a collections perspective. It's hardly about 0.4% of the portfolio. Well in control, and anyway the situation is getting very, very closely monitored, including some tightening of underwriting process as we proceed. But while things within your control are fairly okay, but there will also be scenarios that you have to watch out for from macroeconomics perspective and what's happening in the sector. So the call to reduce the growth rate from about 30% to about 25% now is more in line with what we are seeing around us rather than what we are seeing within us at this point of time. And Mr. Pati has very clearly sort of detailed that out, is that we are not revising any long-term guidance. We are revising the growth guidance given for this year, and we will of course wait and watch as to how the situation evolves and take a call appropriately at the end of this financial year.
Okay. Thanks for that, elaborate. My last point on this, things we discussed. We mentioned about over-leveraged loans, maybe around 0.4% or 1,600 counts, right? My question is, sir, how do you come to know, did we give the loans them at the towards the end, like they were already borrowed from somebody else, from some other MFIs, and then we gave the loans, or what is the sequence of loans, sir? Have you done that study as well? Where they were already over-leveraged and then we gave the loans, because I want to understand the collection efficiency of this particular 1,600 counts, they're below the average, or what's the situation out there?
So Dinesh, both the scenarios are possible. Firstly, let me clarify that at the time of sanctioning of the loan, any loans that they would have had outstanding at that point of time, we would have taken that into account before sanctioning our loan, both from a DBR perspective and from our own risk management perspective. So that's clear. But especially with respect to unsecured loans, you cannot stop any of these people to go and borrow from unsecured loans. And, that's where the over-leverage is sort of creeping up in the sector. So I don't have an exact answer how much proportion of this 1,600 had 3 loans or more at the time of sanction and how much got or borrowed one more loan post-sanction. So today it stands put together about 1,600, but if I were to take a guess, it will be more than 50% of people would have taken a loan after we have sanctioned rather than the other way out.
Okay, so but has this impacted our collection efficiency, because it has marginally gone down, right? So the risk is there, right?
Yeah, the risk is there. That's why we are sort of isolating this 1,600 loans and then monitoring closely. Srikanth can give some more color about the 1,600 loans.
Yeah. So even on this 1,600 loans, it's not like none of these guys are paid anytime during this 6 months. There are customers who have been paying maybe 2 installments, 3 installments during this period, but we are definitely seeing drop in collection efficiency, which means there is some level of issue at their cash flow level, which is why we are monitoring this portfolio. See, the other point, what you said, when at the time of underwriting, we have a very stringent mechanism in terms of not going beyond 50% debt burden ratio. So when you take all of that, it's a little unlikely to presume that these customers would have had all this over leverage even at the point of even at the time of underwriting the loan. So it's more likely that they would have actually taken the loan post re-sanctioning the loan. And that's what Mr. Pati also alluded, right? In a personal loan, there is no security. So for others to just come and give the loan is a lot more easier than when you're doing a secured loan where it can typically be only one lender who can give. So when there is a little bit of laxity in the discipline in the entire lending ecosystem, everybody in the ecosystem tends to get affected. The good part is the effect on us has been extremely marginal. Unlike many other players who have suffered, big on the collection efficiency drops or credit cost or NPAs going up, the impact that we have seen is almost close to nothing.
Okay, sir. It was really great. Thank you. I'll get back into the queue for more questions. Thank you very much. And all the best.
Thank you very much. The next question is from the line of Nischint Chawathe from Kotak Institutional Equities. Please go ahead.
Yeah, I hope I'm audible. Thanks for taking my question. On the credit cost side, I know we're slowing down, looking at what's happening around. But, given the ECL coverage that we are sitting right now, which is closer to 1.6%, do you think it is required that we kind of just inch it up a little bit, and build a little bit of a buffer? Let's say that we would have, something that let's say we would have done during COVID or, any of the stress periods.
So, Nischint, if you look at between the last quarter and the current quarter, it has inched up. It has inched up by about 2 basis points. While obviously you may think that this number is not a big number, but the ECL model also gives us not too much flexibility to sort of keep pushing these numbers, especially when you have strong PDs and LGDs. But yeah, we are fairly in sync with the thoughts that you have echoed, that we will continue to keep monitoring this portfolio, and wherever there is a possibility available to us to push up some of these numbers, we'll continue to keep doing. So our ECL will always be at an appropriate level, depending on how the portfolio is behaving. The bigger impact for us is on the LGD. So even if a loan becomes default, Nischint, the kind of loss that we suffer, and I can give you a number, if you sort of put a weighted average LGD on our entire portfolio, not on our entire portfolio, on the loans that have turned default, it's at around 10%. While if you look at a stage 3, they are holding almost 52% of provision coverage. So it's a very high number that we are holding, while it may be a little archaic from a comparison perspective, but if you look at this to the IRAC provisions that's required, we are almost sitting on 100 crores of additional provisions, 120 crores. So I don't think, we would want to, we had a very detailed discussion, and I think all of us, including the management, the board and the auditors, feel this is a very appropriate level of provision that we are sitting on.
Sure. And are there any covenants with banks on net NPA or any of that?
There are covenants, Nischint, but those are more like 3-4%.
Okay, sure. And just if you
nowhere near our current levels.
Got it. And I think what you mentioned is that you have around 46,000 odd customers who have more than 3 loans. Is that what you mentioned?
It's about 58,000.
58,000. And if total customers as of now are?
About 4.3 lakhs.
Okay, got it. And what we are then saying is that out of these, around 1,600 are the ones who probably have exhibited some stress.
Correct. So it is 4.3 lakhs, out of which about 13.7%, 58,000 customers who have 3 or more loans. Out of this 58,000 customers, 1,600 customers have seen some lower collection efficiencies, which could possibly indicate towards some stress in their cash flows, and we are monitoring that portfolio. So on an overall basis, it translates to about 0.4%.
Got it. And just a little bit of a waterfall on the steady state 6% ROA that we are looking at. If you could give some color on that.
So I think, the way that we are looking at Nischint is about 12% spread, which will mean, about 14 to 15% of net interest margin at a let's say 3.5x kind of a leverage. From there, if we are looking at maybe about 5.5% of OPEX and about a percentage of credit cost, we will broadly be at about 8.5% of pre-tax profit. On a post-tax basis, it should be about 6%.
Got it. And 3.5 times leverage is 3.5 times of equity is something which is agreed with the lender.
See, it's comfortable at the lender level, and with the kind of profits that we also keep generating, we would want to get there first before moving to the next level. 3.5x is a very, very comfortable number for lenders, rating agencies, and the external stakeholders.
Got it. Thank you very much, and all the best.
Thank you.
Thank you very much. The next question is from the line of Arvind from Sundaram Alternates. Please go ahead.
Hello, sir. Thank you so much for the opportunity and congratulations on the good set of numbers despite being in a very tough environment. Sir, one question is, so we have revised down our guidance on growth. If I backward, I could see disbursements has to be flattish or even go down a bit in comparison to the second quarter. If that is going to be the case, would we slow down on the branch addition? Or is my understanding right here, sir?
So Arvind, branch addition is more a long-term strategy of the company. You will have to keep a lot of things into consideration, including putting up the distribution network, infrastructure, the people that you want to put in a branch, and the risk management. So it's not about the quarter-on-quarter growth or in terms of adjusting based on specific disbursement requirement of a company for a particular quarter. So our branch expansions are more from a perspective that we have to become a company with larger distribution outlets, and we are also becoming a lot more well risk managed company. So that has no direct impact on quarter-on-quarter disbursements. So we will continue to do it. And usually also, if you look at our historical track record, we always upfront the branch addition. So any branches that we wanted to put, it will obviously be much higher in the first half of the year rather than in the second half of the year, which is what you are seeing even now. So you will automatically not see us expanding branches in the same pace in the second half of this year, which is in line with what we have been doing for the last few years.
Sure, sir. And if you are going to slow down disbursements, what kind of additional guardrails in terms of underwriting are we going to take? Because if we are going to slow down disbursements, there should be some more. Are we going to require much more comfort on LTV or a FOIR rate? What are the things we are going to do in the near term?
So I think broadly 2-3 things. We have identified certain pockets where the stress could potentially get built. It could be based on a profile of customer, or it could also be based on the leverage of those customers. So for these cases, we will definitely be tightening the underwriting norms, both in terms of LTVs and DBRs. So that's the first step. And second, if you're also seeing any collection inefficiencies in particular pockets, there we will be tightening the entire credit underwriting norms in a much more stringent manner than what we are normally doing for the other part of the portfolio. So we will take a call based on what we are seeing. The Bureau Scrub gave us a lot more insights, and we'll be using that to form the basis of underwriting principles.
Sure. That's it. Thank you so much.
Thank you very much. The next question is from the line of Chandrasekhar Sridhar from Fidelity International. Please go ahead.
Yeah, hi. Good evening. I have a few questions. So, when you dropped the disbursement rate from November, and given that sort of AUM growth, disbursements are maybe going to be weak in the second half, given your sort of AUM number. I mean, if you look historically, typically 40-45% of your AUM is contributed by that year disbursements. That number is actually going to be pretty minimal for this year, and even if we move into next year, the impact's not going to be, very significant. So I'm a little curious to understand why you are saying that sort of you will get to the 12% spreads on an accelerated fashion, especially when disbursement growth is slowing down. The impact on AUM in any ways on 12 months is not, particularly significant. And obviously, coupled with that is, 70% of the borrowings are variable, 12 months out. Even if you have a 25 bits rate cut, it means sort of we get some maybe 8 to 10 bits or 15 bits somewhere, or some sort of an advantage on the borrowing cost. So just curious to understand how you sort of get to 12% spread in 2 years itself.
So Chandra, what we guided is for this year it will be at 25%. For next year, we are not predicating these numbers on a 25% growth. Hopefully there will be some betterment of conditions, and we could look at a different growth. But if you are going to grow at 25%, let us say for the next 3 years, if the environment is going to stay where it is and we'll have to grow only 25%, then I agree with your point. It may not happen in 2 years. And in our guidances that we gave, we have not factored in for any of the rate decreases part. Because I think we also believe that if there is a rate drop by the RBI and our spreads are sort of inching up, we would want to continue to keep passing these, rate benefits to the customers. We would like to operate at around a 12% spread in a steady state scenario. So the question is not whether the spread will go up. The question is we would want to keep the spread at around 12%. The only variable in that is the impact of the existing fixed rate book of about 10,900 crores. How that is sort of going to run down and how the new disbursements come in. There I agree with you. If the growth rate continues to be slow, then 2 years may not be a point. It may get pushed even beyond that. But if you are able to get to a little better growth rate in the years to come, maybe we'll be able to accelerate that a little bit.
Right. So, essentially, you're not ruling out more than a 200 bips. So you're starting off at 200 at some point in time, maybe, 12 months out, if you get a further rate cut, you'll just pass it on further disbursements.
Yes. We will continue to keep evaluating the scenario and, give the benefit to the borrowers. We don't want to, unduly increase our spreads. We would like to operate around the 12% spread, and the sooner that we can get there, I think that's also a comfort internally as well as for the regulator.
Right. Okay. What does this mean just in terms of, given the bulk of, the OpEx is also largely sort of disbursement-driven business. If the disbursement growth itself slows down, I'm just wondering, how do we start thinking? You said 5.5% OpEx. Is curious to understand. Ideally, if your disbursement slows down, your OpEx should actually start slowing down pretty quick, right?
So our our OpEx is, a little more skewed towards fixed, Chandra, rather than variable. So while the incentives are variable and are linked towards, the disbursements, the proportion of the variable as a component of the overall salary is more like about 30-35%. So there is a 65-70% component that is fixed. So even if there is a slowdown in disbursal, you will have to see that. In fact, if you currently look at it, our OpEx is not even at about 5.5% or so. It's lower, but we are not even assuming any scale benefit to come through there. For the current quarter, the OpEx is about 5.1%. But I'm even assuming a little higher number because if the disbursal continues to remain slow, maybe the benefit of scale may not come through. It's actually the other way than what you're thinking. Our OpEx is not much variable. It's about 60% fixed.
Right. And just when you put out a credit cost number, sort of steady state in your ROA tree of 100 bits, you said that your LGD, historically has been 10%. Just curious, trying to put the two and two somehow don't make sense together when you're talking about that. I guess it will be the worst case scenario you would be thinking of in terms of credit cost, right? Unless you basically want to up to your PCR to a certain substantially higher level.
See, there is a buffer built there. Let me not disagree with that. But the question is, it is also a question of how does the numbers look like when the portfolio starts getting seasoned? See, what happens when the growth rate slows is that some of these things that we probably have not seen in the last 5-7 years could probably come through. So we are making necessary allowances for all of that. So if the portfolio seasons, are we going to start looking at some of these things? And when there are, more of legal actions that we take, would that mean that there will be a little more discount that we'll have to give to the customer, which means the LGD, which is at 10% today, will probably go up. So some of these are points that we have actually assumed when we put out a 1% rate. But you are right, the 1% rate is still, is probably on the, the higher end of the range. What we typically guide is about 75 to 100 basis points. When I gave you the ROE tree, I took the higher end of the range.
Right. Lastly, what's the write-off number for the quarter? My calculated number is about 10 crores, but just wanted to get that.
Yeah, it's about 11 crores.
Right. Got it. Okay.
It's 11 crores for the current quarter, vis-a-vis 7 crores for last quarter. So for the full year, we have written off about 18 crores.
Got it. Thank you.
Thank you very much. The next question is from the line of Aditya Pal from MSC Capital Partners. Please go ahead.
Hello. Thank you so much for the opportunity and congratulations to the management on the great set of numbers. So wanted to understand that now on the ground, the issue that you're seeing, are there any particularly geographical pockets that you want to call out where you're seeing a lot of stress?
No specific geographical pockets, Aditya. I think the bureau scrub gave us some insights in terms of particular category of customers, but it is not concentrated to any single geography.
Understood. And sir, a broader point would be that is this a longer term issue that you are seeing? Because what we are hearing from at least the listed microfinance entities is that by Q4 the balance sheet of the customers should be fine with the good monsoon and income picking up in the rural areas. Anything that you want to highlight over there?
See, Aditya, this is my hope is this is not going to be a longer term issues. When the microfinance companies slow down their growth, when they are very clear on whom to lend, how to lend, this scenario, that is, we call that as over leverage scenario, will slowly come down and it will die soon. We are hoping for that. And regulators also are taking a tighter norms on the unsecured loans. So I don't see this panning out for a longer period of time. It's going to be a shorter period of time. The board has taken a very clear call. During the shorter period of time, let's focus more on collections and credit underwriting rather than growing at this over-leveraged time. So that's why we have brought down our growth. So my hope is it should be shorter, maybe not more than 2 quarters from now.
And so another question was that now we are splitting our branches. How long do you foresee that where we are splitting our branches and then finally we'll be following that organic branch growth where this entire program is completed?
Yeah, Aditya, the split branch concept is not for growth. That's for the addressing the concentration risk at a particular location. We have been explaining in a few quarters that when a branch grows beyond a size, we don't want the bunch of our employees in the same location and bunch of our customers in the same location. So to address the concentration risk, we are splitting that branch into 2. So the accounts are equally split, the employees are equally split. So the growth will be as normal. Don't take these branches as new branches because those are old branches where the concentration risk has been put in place. The new branches which we opened 36 and which we will open as we go forward, that will drive the growth much faster.
But Aditya, if I were to just add a little more context to it, because I understood your question slightly differently. You are probably asking us how long will we take when we come back to you and say the entire branches are split and we are done with it.
Exactly.
Okay. Yeah. So I think, we started this about in a more focused manner about 2 quarters back, and we don't want to do all of it together. So we are very choosy and careful in terms of how much we can do in a particular quarter and which states to focus in a particular quarter. Like, for example, this quarter we focus extremely well on Tamil Nadu. In Q1 we focus a little bit more on AP. So we will split it out in such a manner that we are able to digest it well without any undue risk at the ground level. We are right now focusing on any branch which has more than 1,500 customers. So that's the first port of call. Once we are done with it, then we will get down to any branch which has sort of more than 1,000 accounts. So I think in about 2 to 3 quarters, we should have been done with most of this, the splits which are already pending at this point of time. Beyond that, it will only be incrementally and organically, whichever branch gets to that stage, we will get to a split stage. So it's not going to be accelerated like what you're seeing now.
Understood. So by mid of FY26, Five-Star should be back. So this program should have been completed, and we can start reporting on an organic growth branch basis.
Correct. Yeah.
Understood. Thank you so much, and wishing you all the very best, and wishing the team also a very happy Diwali.
Thank you.
Thank you, Aditya.
Thank you very much. The next question is from the line of Siraj Khan, who is an individual investor. Please go ahead.
Hello. Am I audible?
Yes.
First question is with respect to our borrowing mix, how much is linked to the floating rates, so the external EBLR, MCLR? What is the percentage of it? Can you please say?
So we have, given this number. So roughly about 35% is what is the floating rate book, which is typically either linked to about 37% is fixed. I'm sorry, not variable. About 63% is the variable rate, which is linked to MCLR or EBLR.
Okay, MCLR and EBLR. Next, with respect to, so one of the earlier questions that was asked with respect to which of the states in the bureau scrub that were showing any stress. So I did not catch that. Was there any specific states that are maybe in our core geographies that are showing stress?
No, Siraj, we answered it earlier also. So we are not seeing any geographical concentration of stress. The stress is more about a particular category of borrowers who are showing over leverage rather than any geographical concentration.
Understood. So on a corollary to that, in our learning states, that is Rajasthan, Maharashtra, Chhattisgarh and Uttar Pradesh, the new branches that we have opened, how many were in these 4 states? And next question is, how much of a learning curve do you see, and when do you start to see these any one of these or maybe all of these becoming core geographies?
Yeah, so just to answer, I think in the last quarter in Maharashtra we have opened 8 branches. Yeah, so we have not opened any other location. So Maharashtra is the only new learning state where we opened 8 branches. And in the previous quarter, we sort of commented that in Maharashtra we are seeing very good signs of growth at this point of time. We have had more than 4 to 5 years of experience in the state, and you will see us a little bit growing in a more accelerated pace in Maharashtra. So Maharashtra is coming of age in that sense, from a learning state to becoming one of an important state. The other states will take a little more time for us.
Understood. So Maharashtra would be the next geography that could become a core state.
Yes.
Also, what I wanted to know, incrementally, are we seeing a higher growth in the ticket size? Because gradually our ticket size on an overall basis has increased. Is this so? How much of this is natural, and how much of this is purely a credit hunger that is there in the system?
I think for us, most of the ticket size growth has only been natural and more inflation driven. So we are still continuing to maintain about 3.5 lakhs ticket size, which is what we were pre-COVID. And we have been guiding you that any ticket size increases will largely be inflation driven rather than anything else. Yeah, you are right in the sense that this profile of customers are credit hungry, but we are not changing our underwriting practices. So we will only go with what we are comfortable with, and that will, from a ticket size perspective, it will only largely be inflation rate for us.
Understood. And finally, with respect to the credit cost, I think you had said it was 11 crores for the current quarter and 7 crores for the previous quarter. Was that correct?
That's only the write-off. It's not the credit cost.
Correct. The write-off, yes.
The write-off is 11 crores for current quarter and 7 crores for last quarter. Yes.
Understood. And final data keeping, what was the sanction to disbursement and the login to sanction ratio in amount and size, if you could share?
So they have not seen any big differences. The usual login to sanction ratio is about 75% for us, and sanction to disbursement ratio is close to 95%. So these ratios are at similar levels at this point.
So this is both for value of loan and the cases,
yeah,
or is it different?
More value, but these numbers are very close to each other.
Understood. Thank you very much.
Thank you.
Thank you very much. The next question is from the line of Aditya from Securities Investment Management. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Just one question. So we have taken this decision to cut our disbursing yield by 200 bits. But sir, in the previous quarter's con call, we are looking for a rate cut of around 50 to 75 bits. So what has led to this decision of increasing the rate cut?
So Aditya, I think Mr. Pati sort of alluded to this, that we have always been wanting to operate at around the 12% spread. But what's happening in the environment, the external environment, the views of the regulators in terms of what we are hearing on the public domain. So some of these things have made us to take a call where we are cutting the rates a little more sharply than what we have been guiding in the past. So we want to get close to the 12% spread as soon as possible, rather than sort of waiting it out and getting it in a more gradual manner.
Understood. And has there been a nudge by the regulatory authority to cap the rate at which we can give the loan to the borrowers?
See, there has been public commentary by the regulators, which all of us are aware of. And, in some interactions, they have also been sort of trying to understand the reasoning behind the rate that we are charging to the customers. And they have had some inputs, while they have not really pushed or nudged or forced us to do any of these things. But, we are taking it, more on our own. But at the same time, we believe that this will also put us in the good books of the regulator. See, at the same time, our spread being at 12% 2-3 years back, and today it's at 14% doesn't really gel in well. And this is a guidance where they've been consistent, Aditya. We want to get back to the 12% levels. Today we want to get back to that in a little more quicker manner. So that is why it's a decision to cut the rates a little more sharply.
Sure. That's all from my side. Thank you, sir.
Thank you very much. The next question is from the line of Manav, who is an individual investor. Please go ahead.
Sir, as you said that your AUM growth will be slowed down by now, because in Q1 you have told that it would be around 30%, and now you have told that it will be around 25%. So what will be the disbursement growth for this year, FY25?
So Manav, what we have always been saying is, don't get too focused on the disbursal growth, because the disbursal growth is not the only determinant. While it's definitely a pointer towards the AUM growth, it's not the only determinant. The way we will sort of fine-tune our disbursement growth is depending on how the runoffs also stack up. We will ensure that we do adequate disbursals to get to the AUM growth that we want. So while the disbursal growth may not be much for this year, our thought process is most likely you will probably see a flattish disbursal in the second half, or maybe a very small increase as compared to, similar to H1. So if we do a flattish disbursal, we'll probably end up with about 5,200 crores of disbursals for the full year, as against about 4,800, 4,900 last year. So which will mean like a 10-12% disbursement growth, translating to about 25% AUM growth. So it also depends on what is the vintage of the portfolio, what kind of runoffs are we seeing on the portfolio. So our point is, don't get too glued on to the disbursal growth. That will be determined by the company in order to achieve the 25% AUM growth that we are guiding you.
Okay, sir, no problem. And sir, on the ROE numbers, as you said, we are on a long-term basis. You said that ROA would be around 6%. And the leverage now, I think you are around 2.2, 2.3. So what will be the ROE number shaping up for the next 1 to 2 years?
So see, this year we are not seeing, too much of a compression in ROE, because the rate cut, the rate drop that we are doing is only happening maybe for about 5 months of disbursals. So there will be some compression. But our steady state guidance, Manav, is, which we are thinking, in about 2 to 3 years it will happen. It will probably, what we are saying is the ROA will drop to about 6%. And depending on where the leverage is at that point of time, the ROE will be a determinant number.
Okay. So can I assume that ROE would be around 22% by 2-3 years time?
Yeah. See, if the leverage is around 3.5x, it's 6 into 3.5, so it's anywhere around 20% to 22%.
Yeah. Okay. Thank you so much.
Thank you very much. The next question is from the line of Viral Shah from IIFL Securities. Please go ahead.
Yeah, hi. Thank you for the opportunity to ask me again the question. Actually, I had a question with regards to the comment again that you had mentioned about the over-leveraged portfolio and also what is happening in the environment, especially when customers are going out and taking a loan after you have, say, given a loan. So at a sector level, do you see, so in case of MFIs, we have seen that MFIN has now come out with a regulation stating that the loans need to be capped at for lenders. Similarly, have you internally, say, thought about capping, bringing in some, say, underwriting norm when you onboard the customers? Or conversely, is this under discussion with MFIN to ensure that this kind of lending after some other lender has lent does not happen? Not just on MFI loans, but even with any other loans.
See, whether MFIN can control the MFI loans, I don't think MFIN can control any of the other loans. What we are saying is we will put some, stricter underwriting norms, whether we want to disburse, loans to over-leveraged customers or whether, we don't want to, or do we want to cap a lower LTV DBR and all that. I think a lot more will be driven by internal decisions. See, unfortunately, unlike MFIN, we don't have a common regulatory body for, the other forms of MFIs, other forms of NBFCs, because there are, multiple kinds of lenders. There can be business loan lenders, vehicle lenders and all that. So I think we will put some internal norms. We are not really looking at an MFIN kind of directive to come for us, but we will definitely, tighten our underwriting norms.
So my, Shrikant, my rather comment was with regards to have you represented to MFIN because many of these customers have gone out and taken a loan after you have given a loan. And in most of those cases, it's MFI. I understand for other kind of lenders, you don't have this SRO kind of body, but at least for MFIN, can you ask them not just say for MFI loans, but any of the 4 loans? So you don't, those MFI lenders don't end up giving loans to your kind of customers.
No, Viral, I think MFIN has already taken some action, so we will see how that pans out. But it's a good suggestion. Let's see. I think, we can go and suggest will MFIN take is also a point, but, I think it's a good suggestion. We'll keep it in our minds. If we are able to reach out to MFIN, senior people level, we will definitely do that.
Okay. Sure, Shrikant. Thank you.
Thank you very much. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you for allowing me a follow-up. Just one question for Shrikant, sir. Given that, you started doing PTCs and you've seen a good reception from Nippon, Kotak and one more mutual fund that you spoke about, at some point in time, will we also consider doing direct assignments to banks?
So Abhijit, there is no compulsion for us to do direct assignment. Our capital adequacy is very good. At this point of time, we are not really looking at, doing direct assignments because, this, we have always been a company which wants to have the assets on our balance sheet. In fact, we started doing PTC only after Ind AS came into picture because that allows us to hold the assets on our balance sheet. So at this point of time, I think there is not very serious thought internally to do direct assignments, but we will keep our eyes and ears open, Abhijit. So if there is a benefit that the company can derive based on direct assignments, we can look at it. But anyway, given that we are a health to maturity portfolio, we can't do that in big quantums. So at best, it can probably be about 6 to 8% of our overall book.
Got it. This is useful now. Thank you so much and festive greetings to you and your team.
Thank you, Abhijit.
Thank you very much. The next question is from the line of Kushal Goenka, who is an individual investor. Please go ahead. Mr. Kushal, your line has been unmuted.
We can go to the next one.
Since there is no response, we'll move on to the next question. The next question is from the line of Dinesh from Finsight. Please go ahead.
Hello, sir. Thank you for giving me another opportunity. Sir, I have a very specific question here. We are doing pretty well in terms of the PAT number, which is around more than 250 crores plus for the quarters. Can we expect to cross 1,000 crore mark in this financial year? Is it possible?
Yes.
Okay, great, sir. And sir, I have a suggestion here because I was going through our deck and on the last page, on the page 58, we give a very detailed count of like number of employees, and at every count they are because being an investor here, I understand. I would rather suggest we should not give this in so much detail, because since we are running our operations so well, some of the competitors may take a look at it and it could become disadvantageous for us in the future. And if we could just give the total number of headcount, the employees, I think that would suffice, I believe. That's just a suggestion, sir.
Thank you, Dinesh. Your suggestion is taken.
Okay, sir. And my last point is, sir, can we expect our cost to income ratio to, maybe in a foreseeable future in the next 2-3 years to decline to less than 30%? Is that a fair assumption or possibility?
So, Dinesh, if you're saying without, our guidance is inclusive of credit cost, we'll be at about 35 to 36%. So, whether the cost to income X credit cost will go down below 30% and all that, at this point of time, we don't want to guide you. Please go with roughly about 31-32% of OPEX to income and about 3 to 4% of credit cost to income.
Okay, sir. That sounds great, sir. Thank you very much and happy Diwali in advance.
Thank you.
Thank you.
Thank you very much. The next question is from the line of Siraj Khan, who is an individual investor. Please go ahead.
Thank you for the follow-up. So, one question with respect to the branches. So, what is the average time for a branch once it is set up to reach maybe say 1 crore of disbursement, or what is the break-even time for the branch to reach, and then what maybe duration?
So, Siraj, on an average, a branch takes anywhere between 7 to 9 months to kind of reach this break-even point. We define a break-even point at about 2.5 crores of AUM. So, at about 2.5 crores, the branch breaks even on its own costs and starts contributing towards profitability. Of course, the head office costs are not covered, but all branch costs gets covered at about 2.5 crores portfolio. So, this the branch reaches anywhere between 7 to 9 months.
And then, say, on a disbursement basis, per branch disbursements, how much time does it take to reach maybe, say, 50 lakhs of disbursement per month, and 1 crore? How much time have you seen in your experience to reach these levels?
Yeah, I think the rough way to sort of look at it is that each officer can do about 3 to 4 disbursements a month. So just you can round it off at about, let's say, 10 lakhs on an average. So if you have 5 officers or 6 officers in a branch, the branch can easily do about 50 to 60 lakhs of disbursements per month. Now this starts happening anywhere after the 3rd month onwards. So that it takes so much time for the branch to build up a 2.5 crores portfolio between the 7th and the 9th month.
You are saying 50 to 60 files by the 3rd month, you are saying?
Oh, 50 to 60 lakhs of disbursement. Sorry.
50 to 60 lakhs of disbursement by the 3rd month. Okay, understood.
Yeah, from the 3rd month onwards.
Understood. And one more suggestion that I also had. Would it be possible for us to maybe publish a fact sheet? Because that would be very much helpful to maybe go through historical data also. That's just a suggestion. Thank you and happy Diwali.
So we look at it at this point of time. We are not giving it, but your point is taken. Let us see, when we'll be able to implement it. We'll try to do this sooner than later.
Thank you very much and happy Diwali.
Thank you.
Thank you very much. As there are no further questions from the participants, I would now like to hand the conference over to the management for the closing comments. Thank you, and over to you.
Yeah, thank you all for taking your time and asking the questions. Hope we have clarified all. If anyone has any further questions, clarification, please reach out to our IR team. So we'll be happy to take it forward. So, and thank you and happy Diwali to every shareholders and stakeholders of 5-Star. So see you with better numbers in next quarter. Thank you.
On behalf of Ambit Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.